welcome to another episode of Stock Talk Product Review. I am your host, Mike, and I've got a decent show planned for you tonight. It's just me, myself, and I, and we'll be going over some of the top financial headlines of the day. First story we're coming off of, well, all the stories we're going to come off of is Zero Hedge. That is Zero Hedge. So join with me, and if you want to follow along with Tyler Durden. One of the top headlines first this morning was inflation costing the average American family $11,500 this year. Authored by Catella Roberts from the Epoch Times, she puts, Americans are set out to fork out an extra $11,500 this year. Wonder what that's from. Could that be from bad fiscal policy from some people? Some people say don't blame politicians and things like that, but who do you got to blame but the spenders? They want to enjoy the same standard of living and maintained as 2020, according to new estimates from NerdWallet. Can you believe that on there? 2 loaves of bread for $8. I know that's the more expensive kind, but still, that is craziness. The estimates have pushed it into August was based on inflation and spending data from the U.S. Bureau of Labor Statistics. Analysts at NerdWallet looked into how spending would compare to the year 2020 for the COVID-19 pandemic plan. Analysts said the full year of inflation was relatively stable. In that same year, though, U.S. inflation was 1.23%. All in all, in 2020, American households spent $61,300 on average, according to analysts. The number includes everything spending our money on was housing, food, entertainment, clothing, transportation, and everything less. With that, Americans are cutting back and they're trimming back their finances because they are preparing. A lot of people are waking up to the fact that they're preparing for something that they see coming down the pike, which is not good. It stands in 2022 to reach $72,900, a difference of more than $11,500 if consumers want to maintain the same standard of living, they wrote. NerdWallet analysts say the average estimate and therefore is a very exact view. Those who earn more are set to see a more dramatic dollar increase. You could see that going all over. You could see people's faces in the grocery stores and in restaurants and seeing when they're going to order food out, that the prices are going up and up and up, and people are deciding to not get that extra heavy cheeseburger that's $20 or $30, which if you can recall, Monica Crowley quoting with the $30 cheeseburger that she got on her menu for the New York Long Island restaurant that she does takeout to. She said she'd rather just stay at home than not and eat at home before she's going to get that $30 cheeseburger. For those who earn less are less likely or see less dramatic dollar jumps, but the impact of these rising prices could significantly be felt. According to Total Analysis, the total monthly household expenditures is $961 from 2020, while spending up groceries to $101. Shelter is up $120. Household utilities are $70 per household, while gasoline has risen to a whopping $209. And if you recall on last shows that we had before, you had 1 in 6 Americans are in risk of having their utilities shut off. Yes, their utilities are being shut off. 1 in 6 Americans is currently suffering that. That is a true fact, true statement. You can go up and look on the charts on that and use your Google machine to do so. Another Fed rate hike. NerdWallet noted that spending figures in 2020 were less than typical of the given COVID-19 pandemic restrictions, and fewer people were commuting or forking out for childcare and entertainment, resulting in overall decline in spending. They are trying to call relatives, they are trying to call friends to see if they can try to save some money and maybe do some trade outs and things like that, because things are not going that well as like people in the regime would like to say so. It's safe assumption that people are spending less for certain things than this year ago. For another reason, avoid spending high prices, they wrote. This is primarily because they think spending 2022 will be similar to 2020 and 2019. They are trying to cut back and trim back as best they can just because of what's coming down the pike. A separate analyst for Joint Economic Committee Republican estimates for inflation is costing more Americans of $717 each. So they have the inflation rate at 8 and change. But how many of you out there, like to leave it in the comments section, do you think those figures are manipulated, and do you think it's higher? I personally think that the inflation rate is actually higher than it actually is, and I think they're fudging the numbers. Just my opinion, just my speculation. What's your thoughts? A separate analysis from Joint Economic Committee I covered that. Sorry. On an annual basis, the committee estimates the households will about to fork out an extra $8,607. You're kind of seeing shades of, let's just say, the 70s here. That's why a lot of people are putting out 70s music memes, things like that. You are also seeing, if some of you can remember growing up in the 90s, are we about to see what we saw in the 90s and in the 07, 08 era, where we had empty lots, empty construction areas and things like that? Not happening yet. In certain areas it is, in certain areas it's not. Hopefully we don't see that again, but that could be coming down the pike shortly. So a separate analysis from Joint Economic, meanwhile, President Biden insisted earlier this week, that interview on CBS 60 Minutes, that inflation hasn't spiked in recent months and basically is even. And these are the droids you're looking for. We weren't going to get more into this article, but we're just going to go to the Epoch Times if they'll let us go there without having to pay. The next big headline story of the morning that we had is by Tyler Durden again. There is says, are investors staring down the lost decade in the stock market? Are you futurely looking at that right now? Is that a possibility of happening, that we are going to have a lost decade? Possibly, most likely looking towards that. But there is some chances that for gains for that as well. Towards the end of this, we're not going to be covering any stocks tonight because we don't have the rest of the team there. But we're just going to cover this last article here, and we're going to call it a weekend there. Legendary hedge fund manager Stan Druckenmiller, not to be related to the other Druckenmiller, the football player, in an interview with Palantir CEO Alex Karp, gave a pretty bleak assessment of the stock market for years ahead. Finally, people are actually, it's nice to see that a lot of people now do not want to go down with the sinking ship, the Titanic. And so they're all coming out and starting to speak out. I appreciate that. You have to give some of the other side, kudos when they're actually going to start reporting news and not trying to hide for because you don't want to be tied to what's coming down the pike. There's a high probability in his mind, he says, that the market is going to be kind of flat for 10 years. Is that an understatement, guys? I think, or is that true? I think that he's got more than I think we're just more than just flat. He says the time period between 66 to 82 time period. Kind of agreeing with him there, but it could be worse. We are two separate ways. We're two bad moves away from hitting bad news bears here, as far as with the D word, which we don't want to say on the show yet. And that would be two bad spending ways. This would leave some wondering specifically that Stan is so bearish today. Well, as the Fed recently warranted that the windfall corporate profits driven by interest rates and corporate tax rates falling to the floor is phenomenal and simply won't be repeated. The reduction in interest and tax expenses is going to be full of 1/3 of all profit growth over the next 2 decades period, Jesse Felder says. The boost to corporate profits is unlikely to continue. You're also seeing another article you can read out here, read on Zero Hedge as well, is that you are seeing, remember how we had that big ships, the port blockade, things like that. Everybody was all clogged up. We had a supply chain crisis and everything like that. Those ports are empty right now. The ships aren't backed up. There are not a lot of imports. You are not importing a lot of goods right now. That is another sign. They don't want to say the R word because of recession. They don't want to say any of that before the election, so you're going to hear that tidy off. But you're seeing those ports on the West Coast, and they're not backed up or anything like that because there is no port backup because imports are down tremendously. That boost to corporate profits is unlikely to continue, Jesse says, indicating that there are notably lower stock returns for the future. In context, when equity valuations discount the phenomenon of capturing indefinite into the future, that's the real problem. Regardless of valuation ratio, you use, and then he has the formula here, formula for 10-year expected total return, where G is expected to grow your fundamental, and he says, P.S., unless you expect permanent rising margins, exclude amortization, contribution of past margin expansions. So that's from John Hussman, PhD there. And then he leaves his chart with his receipts to prove his point. And he says, as a result, investors are likely Tyler Durden writes, to be going to do more than just be passive, but buy and hold broad stock market index if they're going to avoid a prolonged period of negative real returns. So there you have it on that. You can read the comment section on that. Are we going to see a lost decade? We'll have to see how that plays out. Just prepare for tomorrow. And you guys have a great weekend. I hope you enjoyed the week and some of the charts and some of the stocks we shared with you. Don't make it a dog show. And good night now.